Good morning, hunters, and welcome back to the Daily Hunt for Multibaggers on this Wednesday, January 21st, 2026. We've got a busy show for you today, packed with insights from yesterday's market discussions.
That's right, Ethan. Our AI dug through hundreds of posts from Tuesday, January 20th, flagging quite a diverse set of companies. We saw a lot of chatter, from tech giants to memory chip makers.
Yeah, the sentiment out there is definitely giving us some mixed signals. We've got sectors showing immense growth potential, but also some serious caution flags being raised, especially around valuation and, some of the more speculative plays. It's a real tug of war for the market right now.
Kicking things off today, let's talk about Netflix, symbol NFLX. This one has been a constant topic in the community.
It has, Brooke, and the buzz has been really something. Some users are calling it an absolute steal right now, even predicting explosive growth, potentially reaching $200 within 3 years, largely on the back of this anticipated Warner Bros. Deal. Plus, we've seen some insider buying, which is always a vote of confidence. They were even rated a cautious buy by us just yesterday.
Well, Ethan, while that long-term vision is certainly appealing, the numbers are raising some serious eyebrows for me. Despite beating Q4 numbers, the Q1 EPS forecast completely missed expectations, signaling a slowdown. The market reacted immediately, pushing the stock closer to its 52-week low. And let's not forget that PE ratio, sitting at around 34.49. That's a high valuation for a company that's now guiding for slower growth and dealing with significant financing costs from that Warner Bros. Deal you mentioned. Plus, their debt-to-equity ratio is high.
I hear you, Brooke. The short-term picture definitely looks challenging, and that Q1 guidance miss is a real gut punch for growth investors. But sometimes these dips are exactly when the long-term opportunities emerge. If that Warner Bros. Deal truly gives them a monopoly, as some are saying, those growth numbers could turn around fast, making today's price look like a bargain.
If is the operative word there, Ethan. Given the immediate market reaction, the high PE, and the financing costs impacting future profitability, I think we need to be very cautious. The risk profile has significantly increased since our last assessment.
Fair enough. For now, despite some of the long-term optimism, the immediate financial signals are too strong to ignore.
So our final verdict on NFLX for today is stay away. It's a downgrade from yesterday's cautious buy, which reflects the significant shift in forward guidance.
Next up, let's discuss Apple, AAPL. Our data flags some bearish sentiment here.
Indeed, one user even celebrated a $90K gain from a bearish trade, calling out that AAPL had been beaten down for weeks. From a KPI perspective, while Apple's fundamentals like return on equity and net profit margin are exceptionally strong, its valuation is a concern. The PE ratio is over 33 and the price to book is nearly 50. That's a huge premium, and it makes the stock vulnerable to any negative news or missed expectations. Plus, their debt-to-equity ratio is quite high at 152.41.
Well, even with a pullback, Apple remains a powerhouse, Brooke. They just topped the China smartphone market in Q4, and a French court ruling let them keep their app tracking transparency feature. Citigroup still has a buy rating with a target of $315. These strong underlying strengths mean any dip could be a chance for long-term growth.
That may be true for the long term, Ethan, but the current premium valuation combined with that high debt and the recent bearish momentum means the downside risk is very real if growth doesn't consistently meet those lofty expectations. It feels like a crowded trade that's now unwinding a bit.
All right, for Apple today, weighing the high valuation against its fundamental strength and recent sentiment?
My verdict is clear. For AAPL, it's a stay away.
Moving on, let's talk about Micron Technology, MU. This one has a much more optimistic feel in the air.
It does, Ethan, though one post mentioning it in the NFL thread was quite brief. However, the comprehensive analysis for MU is strongly bullish.
Yeah, the sentiment is overwhelmingly bullish, driven by what folks are calling a memory supercycle, thanks to the explosive demand for high-bandwidth memory in AI. Micron is seen as a key player, an engine room in this trend, showing an impressive 82% gain. RBC even started coverage with an outperform, seeing over $50 peak EPS potential from HBM. And get this, insiders have been buying a massive 32% of total insider shares in the last 6 months. That's a huge vote of confidence. We even had it as a buy yesterday, so the trend is strong.
I see the enthusiasm, Ethan, and the 56.7% revenue growth is certainly impressive. Insider buying is a very good sign. However, the PE ratio is still high at almost 35, suggesting a lot of future growth is already priced in. And while their return on equity is excellent, I do note that the debt-to-equity ratio, while lower than some, is a point to watch, especially for a company in a cyclical industry.
True, Brooke, but the demand for AI is anything but cyclical in the short term. Analysts are raising price targets, seeing MU as a top AI chip stock over even NVIDIA. This looks like a major shift, not just a temporary bump. The future EPS potential could dramatically lower that forward PE, making it look much more reasonable.
Okay, I'll concede the strong tailwinds even. The revenue growth and insider activity are compelling. This does look like a strong position in a high-growth area.
So our verdict on MU?
Despite the PE, the growth drivers and insider confidence are too strong to ignore. For MU, we're classifying it as a buy. That's a reaffirmation of its previous rating.
All right, let's shift gears to MicroStrategy, MSTR. This one seems to be quite the hot-button issue, and not in a good way.
Definitely not, Ethan. The overall sentiment is strongly bearish. Users are calling MSTR a fraud due to dilution and that it's easy to short. One comment even said it's a shitty stock where people have lost their portfolio. The company's strategy is seen as heavily dependent on Bitcoin with high leverage. You know, some users do believe that if Bitcoin heads to 150 to 200K in 2026, MSTR could triple or quadruple. It's really tied to that crypto bet, and if you believe in the future of Bitcoin, then MSTR could ride that wave. But that's a huge if, Ethan, and the KPIs scream danger. Its current price is near its 52-week low, and historical performance shows a steep decline. The beta is an extreme 3.433, indicating wild volatility, and its debt-to-equity ratio is exceptionally high at over 14. That leverage, coupled with its direct tie to a volatile asset like Bitcoin, makes it incredibly risky. Even the news is negative, questioning if their Bitcoin treasury strategy is no longer working.
I get it. It's definitely a high-stakes play, and the volatility is not for everyone. No, it's not. The risks far outweigh the potential rewards for most investors, particularly with such a leveraged and dependent strategy. Our verdict for MSTR is a firm stay away. It's been a consistent theme for the stock, and this reaffirms that.
Finally, let's talk about Sandisk, SNDK. This is its first time on our show, Brooke.
And it's coming in hot, Ethan, with some wild numbers. The post talks about a memory supercycle and a vertical move with a 197% gain. Citigroup even raised its price target to $490. That sounds exciting, and the 22.6% revenue growth is solid.
Absolutely. The AI demand is aggressively rotating capital into hardware, making SNDK a key beneficiary in this memory explosion. It's been hailed as a top S&P 500 performer, and there's insider buying happening too. It really looks like it's riding the crest of the AI wave.
It's riding a wave, all right, Ethan, straight into extreme overvaluation. While the growth story is compelling, our analysis and the community comments are screaming caution. The stock is trading nearly 20% above average analyst targets already, with some calling it insanely overpriced. And here's the kicker. Despite all that revenue growth and stock performance, SNDK currently has a negative net profit margin and negative EPS. They are unprofitable. And to add to that, their debt-to-equity ratio is extremely high at over 16. Investing in a loss-making company at its 52-week high after a nearly 1,500% gain from its low is pure speculation.
Wow, negative profitability. That's a tough pill to swallow after such a run. But if the memory supercycle truly takes hold, those profit margins could swing positive dramatically, right? It's a bet on that future potential.
It's a very big bet, Ethan, and one that comes with immense risk given the current financial state. The market is pricing in a lot of future success that simply isn't reflected in current earnings. It's tempting, but the red flags are too significant.
All right, Brooke, you've convinced me on the immediate risk here. So what's the call for SNDK, its first appearance on the Daily Hunt?
For SNDK, it's a clear stay away for now.
All right, hunters, let's recap the stocks that caught our AI's attention today. Investigate as buy, Micron Technology, MU. Investigate as cautious buy, none. Investigate as speculative gamble, Netflix Inc., NFLX.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
That's all for today's Daily Hunt for Multibaggers. Thanks for tuning in, everyone. We'll catch you next time.